Good morning. This is Mike Youngman, Chief Investment Officer for Ankerstar Wealth, with a special guest today. Steve is out meeting with clients. We have David Chisholm, and today's topics we're going to cover is, new market highs, which is a frequent topic. It seems like we hit this multiple times a week, which is a great thing to have. My visit last week to JP Morgan Chase, and then David is going to cover in-service rollovers, an option for those of you with a 401k. But before I get started, I have to say this is a financial education presentation. You must do your own due diligence on anything that you hear. More disclaimer information can be found at ankerstarwealth.com, and the opinions expressed are mine and David's alone. So, green markets. We love green markets. And I'm going to start off by sharing that good news. Let me bring up my screen, and you can see mostly green across the board, a little bit of red in the NASDAQ. But what I want to highlight is the S&P 500, which is bumping against 5,500. It was there earlier today and bounced back. And while we're not, just invested in the S&P 500, it is a good measure of the overall stock market. Although it is certainly weighted towards the biggest companies of Apple, Microsoft, NVIDIA. They drive it more than stocks 497 through 500. But this is a year-to-date graph. Overall, the S&P 500 is up, 15%. I know coming into this year, many analysts were saying 9 to 12% would be a great year, and we're up 15, and we're not halfway through the year yet. So what does that mean? Does that make you think, well, I should just buy, go to cash the rest of the year and sit? That's a temptation to do. But before you do that, I just want to go back a few years and show you the danger of doing that, because this is a 5-year graph. And if you look at 2023, you might have done the same thing. You might have done the same thing last year, because when it hit July, it was up significantly, like 15% or so, and then it dropped. And you might have thought, oh, I made the perfect decision. I got out of the market and it dropped. And then you would have missed this gain that has continued to run up. And the danger of trying market timing, there's lots of dangers, but one of the major dangers is when the market goes up, how do you get back in? Because it's hard to make yourself buy at a higher price than you sold at. It's like, oh, I missed that out. I want to get a deal, and it may never happen again. So that is not what we advocate is to pull out. But overall, market's doing good. We'll continue to monitor Fed rate reduction, inflation, joblessness, and presidential elections coming soon. The other topic I wanted to hit for my part is last week I was at JP Morgan Chase headquarters with a wealth management conference, and I'm going to show a couple slides. So there's the building I was in off Madison, incredibly tall building for those of us in Ohio to go to New York City. This was the Wealth Management Summit, and you may wonder, like, what do we do there? Like, what kind of things? So a lot of the ETFs that we invest in, things like JEPI or JTech, the portfolio managers were there to answer questions. So about 120 of us there can ask questions ask more detailed questions on the economy, the holdings. One of the interesting topics was what's the next thing beyond AI, or what's the AI stocks that could gain beyond the ones you already know about? Like, what's the next ones? So we went into that, and we'll be looking to add some of those after we do some more due diligence into our book of business. Couple pictures there. You can see me look with the Met building behind me. And then I thought this was really cool. You may say, wow, why is he showing a picture of some guns? Around my house, big Hamilton fans, and the Hamilton Burr dueling pistols were on display, and they were purchased by the Bank of Manhattan, which I guess was purchased by JP Morgan Chase at some point, and they actually had them. And I just thought, wow, that's pretty cool. So I took a picture of that. So anyways, that's some of what we do. I'll liken the experience there to like going to the Apple store. So when you go to the Apple store, they don't try to sell you a product. They just educate you on the products and you choose to buy. And that's the same way with dealing with different ETFs is they explain what their product entails, let you ask all the questions. There's no pressure. We are fiduciaries. We are doing what's in your best interest, and but it's good to ask the actual portfolio managers, hey, how'd you pick that, or why are you doing that? So, anyways, I'm going to turn this over to David, and he's going to cover the in-service rollover.
All right, good morning, everyone. So what is an in-service rollover? Very simply, it allows a current employee, so who you're working for right now, to move all or some of your employee-sponsored 401k plan into an IRA without taking the money as a distribution. So you have the ability, if you want to roll over your 401k into an IRA currently. What are some of the benefits of that? Well, you have the ability to pick your investment options, strategies. You have a lot more options that way, whereas in your 401k, you have limited mutual funds. You may have 20 or 30 funds to pick from, but you don't really get to pick your own investments. Another benefit is that you have the ability to begin using your working years when you have income coming in to begin rolling over that IRA into your Roth IRA, paying the taxes on it up front, get it into the Roth IRA. You never have to pay taxes on it again. There are a couple of things I want you to be aware of if this is something that interests you. What I tell the people that I've spoken to about this is you need to sit down with your benefits people and discuss it with them and ask questions. Limited. Some companies don't allow it. A lot of companies do allow it. It may be limited to those of you who are over 59 and a half, which would make sense because at 59 and a half, you can begin taking distributions penalty free. And so they may have that restriction on there, but it depends on the company and the 401k and the 401k plan provider that they use. They have all the rules in place, and you would have to sit down and discuss with them what it is. But it is another tool that you have in your belt to answer what I think is a simple question, but a very difficult question to answer, which is your money working for you in the most efficient manner that it can? And that's what we try to do with you through what we do, is make sure that it's working for you in the most efficient manner that it can. So it's just another tool in the belt to consider for those of you who are interested.
Awesome. Well, thank you, David. And, having been at corporate places and, I've seen it from 401ks with not very many choices to 401ks with lots of choices, but I don't know that they're very good choices just because there's a lot of sometimes high fee choices in there. Obviously a lot of people put money in their company stock, which there's some good and bad to that. I mean, there's good if the company goes up, let's say Costco, or if you work for NVIDIA, not so good if you worked for Enron or even General Motors. But this is a great option, whether it's an in-service rollover or even a self-directed IRA, sometimes or self-directed 401k. Those options are at some companies as well. But I would say if you're interested in this, please contact your financial advisor at Ankerstar Wealth, and we can talk through it. You will have to follow up with your company to find out if they allow it, but more and more companies are. So with that, I will close today, and hopefully Steve will be back with us soon. Thank you, David. Bye.
Bye.